Nordhaus, and welcome to Monday Morning. We're going to be understanding total cost of risk is the name of the program, and it's something that I never really understood before until I got to talking to Rob Eckern. I thought total cost of risk is what you got insured for, and whatever risk you had, and you had to pay the anyway. A lot of other people felt the same way. But when I heard Rob Eckern the first time, and he began to explain this to me, now I have an understanding that it's a whole new ball game out there. It's the same ball game, and it's just all called different. It's something we have to recognize. I'll tell you about Rob. I've known him for many years, about 30 of his 40 years, 35 of them when he came into the agency business back in Fargo, North Dakota. He was he started your own agency from scratch.
Well, that's right, George. I was a young man at the time and probably too stupid to know I couldn't do it, so I just did it. And
oh yeah, but then you started producing for Willis, and anyway, I mean, you became a real producer for them. Willis, of course, was one of the huge ones. I knew a lot of their people over the years, and then you started. I guess you've been consulting for something like 20 years now, and your organization consults for big businesses. Well, not I mean for big. On a big account, bigger accounts, or at least commercial lines accounts. I guess the cost of it doesn't make any difference on the T-Core, does it? The cost of if big accounts or small accounts, it's still the same situation. But,
well,
go ahead.
Well, George, I was just going to say that, thank you to you and over the years, and again, going back to my 40 years of experience, I do recall you coming to where I first had my insurance agency, Fargo, North Dakota, and putting on a seminar on agency management. It was a 2-day seminar, and those were the good old days, George. But, since that time, I did leave North Dakota, moved to Phoenix, became part of Willis, and ultimately one of the top brokers inside of Willis. We work now with primarily large brokers, many of which are top 100 firms, and helping them understand how to differentiate themselves by producing large accounts and in working with total cost of risk. Now, total cost of risk, or T-Core as it's commonly known, was first developed by risk managers in the 70s. And it was developed so that risk managers could have a conversation with their bosses in the financial suites, with the CFOs. Because in many cases, the CFOs or the executives of the firm would say to the risk manager, you've asked us for an extra $200,000 for our budget next year. What are we going to get for that? So the risk managers had to have a way that they could actually show the ROI to their bosses. Well, during the 80s, this was adopted, this methodology, by the mega brokers, and that's when they first started working with it, and I was one of them, because it gave us talking points with large buyers. It allowed us to go in and be perceived as sitting on that same side of the desk with the buyer so that we could show them how we were helping them impact their costs. And it became translated into the middle market agents and brokers and middle market buyers in the 90s. In fact, our firm was the organization that did bring this to the middle market agents and brokers. Others have since copied it, and as we're going to talk today, in the true sense of total cost of risk, there is a difference between what is the accurate total cost of risk and those that in some cases are being shown to buyers and brokers. But it's the only way of actually creating a value proposition, and everybody talks about that now, in the value proposition. But total cost of risk is the only way of actually creating one. Now, George, when we talk about total cost of risk, what we have to really understand is that the premium, in many cases, is the smallest part. When you look at how you can help a buyer cut their costs, it's really the smallest part of their true costs. So firms that understand this, and brokers who understand this, are able to bring in risk control services, claims management services, and talk about their impact on the buyer. Now, they'll then begin to say, oh, by the way, we can get you a quote-unquote competitive premium too. Now, this particular survey was done a number of years ago, and what it showed is that 20% of a buyer's cost savings is in the insurance premium. The rest is in total cost of risk.
Well, that's an important number. Wow, that's scary. I had no idea it was that way.
Well, and you know, George, what's happened over the years is the buyers that have been chasing, or the brokers that have been chasing it on the right side have been chasing the wrong rabbit, because you can't continue to sustain premium decreases, and everyone talks about the, price sellers. Well, if you're chasing only the insurance premium, you're leaving 80% of the buyer's costs on the table. And that's why many brokers and agents find themselves with broker of record letters put against them. Or the astute ones work on the left side, and that's how they're able to get the broker of record letters in midterm. So before we get into the actual nuts and bolts of this, we've got to at least kind of have a basic understanding. Total cost of risk is made up of 4 distinct pieces. Yes, there is the premiums and maybe the fees or any assessments if it's a captive operation. Anything having to do with the risk financing costs, yes, that is a piece of it. But then there's the buyer's loss costs, retained losses, and indirect loss costs. Now, many agents and brokers miss this because they're passing losses off to the insurance carrier. They might not be dealing in a captive or a high deductible plan. It can well be a first dollar program where the insurance company is paying all the losses. Well, when that happens, what the broker is missing, and it's the key to this, is all the indirect loss costs that are still burning a hole in the buyer's financial statement. And, an example of this, George, is what we've talked about for years, is the iceberg of indirect loss costs. And workers' compensation is always used as the example, so I'll use it now. But it's the same in any type of insurance program or loss, whether it be auto or casualty, liability, property. But I'll use workers' comp because it's the easiest to understand. If a buyer has a loss in workers' compensation, yes, the insurance carrier is going to pay the loss, but there's a whole nother set of costs that are on the buyer's financial statement in the way of increased costs of investigating the loss, retraining a worker, the productivity that they lost, and that the line stopped moving. Perhaps it was to their brand because it was a big loss and it was in the newspaper. I mean, there's all kinds of additional costs that occur because of that loss. That becomes part of their total cost of risk. A third piece to this is how a broker helps a buyer reduce costs inside of their program when they provide them with projects or resources or services. Now, many agents and brokers put those all under the banner of value-added services, which, as you know, I really don't like that term because it doesn't put a value of what it really is to the buyer. It's really tough to talk about value-added services if you can't say to the buyer, and this is how much we've impacted your costs. So let me give you an example. Many of your listeners right now are involved in clients where they may be providing, it might be through the carrier, it might be through their own services, a risk control assessment or a loss assessment. Well, that is a cost that the buyer didn't have to pay someone else, a third party, let's say like a consultant. And that is the impact of handing them anywhere between $2,500 and $25,000, depending upon how complicated the risk is, in a consultant's report. Or a situation where a broker may untangle a buyer's certificates of insurance program, and we've all seen those, where a broker may help a buyer untangle a program where they had maybe 2 or 3 or 400 certificates of insurance. You know, that's a project that's worth anywhere from $5,000 to $10,000 to the buyer, and we don't talk about those things. So total cost of risk ties all this up, and then of course the carrier, the taxes, and the fees are kind of you know, part of whatever the risk financing cost is. But most agents and brokers only tell half the story. And I can say this because I've seen the work of many of the mega brokers and many of the larger agencies and brokers who don't work with us, by the way. They'll go out and they'll talk to a buyer about total cost of risk, but they'll only talk to them about how they're impacting their risk financing costs or their retained losses, and they will include in that perhaps the cost of collateral or other things, but they're not showing them their impact of their indirect loss costs, and they're showing their resources as features. And you know, the reason this happens, George, is because in many cases they don't have the data that they need to be able to do the quantification, or they weren't planning on providing the client with any risk control services to begin with. So if you can't show it to them, if you're not going to provide it to them, you don't show it to them. But what happens is, because of it, they're missing, as we talked about earlier, the wrong rabbit. They're going the wrong way. So, you know, here's the thing that we need to really understand is that the risk financing price and TCOR, in most cases, are the same unless you can quantify your resource capabilities. And that's
lost you there.
where...
Wait a minute, lost you right there. You see that last thing and you quantify, go from right there.
All right, that the risk financing and the price are the same unless we can put resources in play. Resources are what gives agents and brokers the ability to leverage and show the value. It's the resources of what did our claims management really do in reducing claims, because if we know that there's an indirect loss cost attached to every claim and we reduce that claim, not only did we reduce what the insurance carrier might have paid, but we're going to reduce the buyer's indirect loss costs. If we put in a risk control program that has loss control, not only are we avoiding a loss, but we're reducing the future indirect loss costs that the buyer had absorbed in the past on their financial statement through financial leakage. If we brought in specialty resources, and specialty resources are things such as Xywave or Modmaster, or some of the things that are out there, Advisen, some of the things that are out there that will help a broker provide a buyer with information, what we're doing is we're reducing their costs, and therefore reducing their total cost of risk. That becomes the value proposition that's quantifiable. Not value-added services, the quantifiable impact of what we've brought this buyer and how that becomes important. So, if we want to create a true value proposition, What we need to be able to do is actually quantify the impact of these to the buyer and have them understand it. It takes what we've always called, value-added services, or I call them just features. In selling, George, we were taught very early on, and most of us in our selling careers, the difference between features and benefits. Features were the services. We provided you this and this and this. The benefit is the financial outcome. Because we did this and because we were successful, this is how we changed your cost structure. So, that is the basics of total cost of risk. It's the vehicle that proves we are who we said we were. It's the reason why you appoint us as the broker. TCOR is simply the vehicle of showing the buyer in quantifiable terms with evidence. This is how we have impacted your financial statement. Now, this would be in a stewardship report. Or this is how we're going to help you recapture your financial leakage and reduce your costs. And that's how we would do it in a new business presentation. The difference is the value. So let me talk just for a minute, George, and kind of give you an example of how this works in the real, in the real world. Now you may notice up there, there's a logo that says TCOR Calc.
Yeah, right. What's that?
Well, I need to explain that for just a minute. What we learned early on in working with this is that there has historically been no source for the data that's needed for agents and brokers to actually work with this. So we've started a company called TCOR Calc, which is gathering the metrics that agents and brokers are using with their clients and with CFOs. And it's what it's doing is it puts together the actual analytics now that agents and brokers need to work this way. So what I want to say is, as we're talking about this, and you see indirect loss cost factors, these are gathered through our TCOR Calc, but they're changing by the minute. So don't presume this is the indirect loss cost factor today at this point. But because of our cloud-based analytics system, we actually know what indirect loss cost factors are. So let's talk for a minute just about this example. So to talk about chasing the wrong rabbit and how TCOR works. Let's take an example of a workers' compensation program over the last 3 years, let's say. And many agents and brokers chase one thing. They'll chase the experience modification, and they'll say to a buyer, your experience modification factor is 1.1. We want to help you cut that by 15 points. So, if the premium, I'm going to make up something here, is $100,000, we're going to try and save you $15,000 of experience modification. And I will tell you that this is where we're chasing the wrong rabbit, because these are the facts. Let's say in this account you've got a situation where you've got a client who has $77,000 of losses in the first year, they've got $110,000 losses in the second year, and they've got $99,000 of losses in the third year. They have a total of indirect loss costs that inside of their financial statement that have added $343,000 to their cost structure inside their business. And this $343,200, it doesn't show up as a line item, but it's the actual costs that are inside of their business. So if we understand total cost of risk, and if we use our resource capabilities, and we look to go back in time and remove reserves. Now, in this example, we're going to have gone back and we're going to have attacked the reserves, which is what good claims management does on accounts, and we reduced their reserves by $106,000. And if we can go forward and know that we're going to help them avoid losses of $178,000, what we're looking here is a stewardship report says we're going back. If this was a new business presentation, we would go forward. But here's what it means to them. If we're going to go and we're going to reduce their losses, and we reduce their claims, let's say, by $22,000. If we reduce their claims by $22,000, suddenly we've got an indirect loss cost reduction of $26,400. Going forward, we're going to have avoided some of these claims, and that's going to be another $54,000. So what we're doing in essence is we're reducing their claims by $67,000 using an indirect loss cost factor of 1.2. Now we've got an $80,000 cost reduction. So let's go back to our example. What we're looking at here is using the same numbers that we had before, but we're reducing these loss costs by $80,000. And because of it, we now have a revised loss cost, the revised costs of $262,000. So what's happened here is we reduced their total cost of risk by 24% from the indirect cost structure. Do you see what happened there, George?
I think so. I think I have to study this, but I can come back to it. Go ahead.
Well, I mean, you know, what we did is if we can reduce their loss costs, which is what we've done, we in essence have reduced their cost structure by $80,000. And before, when we were just looking at trying to change the insurance premium by an experience mod of 15 points, we were going to save them on a $100,000 transaction. We were going to save them $15,000. Here, we reduced their cost by 80, and the premium hasn't changed. And that's how people take broker of record letters. So now let's take it forward, and let's say that we're looking at their administrative costs, and we talked about providing them with reduced costs inside of their business. They have a let's say, for instance, they have a fellow that is, or a person that is their, it's a contractor, and they have a person that is their job superintendent, and he's costing them about $80,000 a year. But 30% of his job is to go to different job sites and put on, make sure the safety is being put together right, making sure the training is being done correctly, et cetera, et cetera. But we help them do that. In fact, we take over perhaps their job site safety program. Well, what we've done there is we've made him 30% more effective because we've taken that away, which is in essence a $24,000 cost reduction. We did an EMOD study for them. We did go in and we did put together, let's say, an EMOD program. Well, you know, the value of them buying that is close to $5,000 if they were going to pay an actuary to do that. Or we also, let's say, had a behavioral modification study where there was ergonomics that was involved with this. And we went in and we helped them. Now, we, as the agent or broker, may not have done that, but perhaps we managed the carrier's resources to do it. Suddenly, there's a value there of $7,500. You know, when you talk about some of the portals and some of the things that I'll use again, Xywave as an example, just because they come to mind, a big piece of what they do, if those of them that use it, is they provide regulatory information, et cetera, et cetera. When that happens, if we can get them information quicker than they were going to get for themselves and save someone who maybe is a $40,000 expense and reduce their time by that 15%, suddenly that's a $6,000 cost reduction. So, these are things that agents and brokers do all the time. And again, you'll see the T-Core Calc logo there. These are the things that we've already valued, and we know what the value is of this. So in essence, now we've reduced the buyer's cost by another $42,000. So let's go back to our example. We're leaving the premiums the same. We've reduced their loss costs by $80,000. We provided them with another $42,000 of cost reduction by providing them with services that they would have had to purchase for themselves. The bottom line is that we've reduced their costs by doing this by $122,900. And for agents and brokers who are chasing the risk financing piece, that perhaps they could reduce the premium by $15,000, which is the right rabbit for them to have chased. I think you can see now how total cost of risk is really the way that agents and brokers that are looking to continue to be successful in this business are working. And because there is now data that exists, they're able to do it. The key to this, and this is where agents and brokers, the good ones, are really understanding this, is they're looking to move their business model, the business model of their agencies and brokerage. They're looking to move their entire large account sales platform to address the issues that CFOs are concerned about. Because when you call in a CFO, that CFO, when you call them, they're thinking in terms of how can we improve our business? Our business perhaps is maybe reduced. We're under competitive pressure in our products. We just lost a big customer, and we have to worry about replacing that revenue stream. Everything we're talking about now in reducing their cost structure is able to offset some of these things that firms have been worried about for a long, long time. For the very first time, agents and brokers are able to call that CFO and sit on their side of the desk. And that's the future of this business. Because what it's going to let us do, and this is a subject that we'll be talking about at an additional point, is you can say to a buyer, these were your costs before us, these were your costs with us, or that's a stewardship report. Or on a new business, this allows them to call on a buyer and say, this is what your current cost structure looks like, and this is what it will be with us. Now, when we apply this to your various business metrics, which is really the key to the future of business and our business. When we apply that to that, if your profit margin is 20%, we can provide you with an additional X amount of profit. See, all of a sudden now, we're not in the value-added services business. We're in the outcome business. And that's what total cost of risk is used for. So, total cost of risk is a huge subject. But I think, as I mentioned to you, it's really the only measurement for a brokerage client value, because it gives you that 360-degree view of what you've actually done for a client, or what you're going to be able to do for a prospect. And for years in this business, we've always talked about trying to differentiate ourselves by something other than price. Well, this is it. This is the only way to do it because it lets you translate your outcome to the client's financial statement, and it gives the buyer evidence based upon fact as to what the outcome that the broker is providing a buyer. And George, what I want you to know is this is how the large brokers work on a daily basis. On large, I mean huge accounts. This is how they work. But now, what we've been able to do is bring this into the middle market so that middle market brokers and regional brokers and independent brokers can work with the same level of confidence and work with larger accounts, because that is going to be the future of our business as more and more agents get intermediated by, simply the commodity. So, George, I appreciate, all your work, and I wanted to give your listeners kind of a sense of, what the importance is of total cost of risk in them growing and retaining their large account book of business.
Got it. I got it. They can get hold of you by going to C.R. Eckern.
Well, yes, George, the best way to get a hold of us is to go to info@creckern.com, and that'd be info@creckern.com, or of course we also have a website which is www.creckern.com.
Well, Ron, you've opened my eyes, and I suspect that this is the second of 4 of these we're going to do. You're going to do another one on preparing and delivering stewardship down the line, and we're going to do another one on the new business broker of record appointment. And these would be ideal for any agency doing commercial lines in the middle market to get this in front of their people. All 4. This would be a great lesson, and I'm sure that they call you, you'll be able to help them. So thank you very much for all this, and I appreciate your picture and my picture in the August issue of Rough Notes, telling about Monday morning. So that was really kind of nice, wasn't it? So
yeah.
People can go in and see that, and we always like a little publicity. And so, Ron, I do thank you again, and suggest to people to go back and go to the quiz flash of the day or the E&O tip of the day. You can get that back on your email. And Ron, I want to thank you, Rob, again for a really, really in-depth thing that I needed to know, and I suspect so